An all-in-one guide to the basics of accounting. Throughout this channel, we refer to the accounting cycle. In basic terms, the accounting cycle shows us all the steps that need to take place when dealing with accounting. But don't worry, each of these concepts will be covered in depth in this channel. This is just a basic overview. So, imagine you are the owner of Bright Gym, and in May you decide to expand your business by selling t-shirts to gym members. So you decide to buy 200 pairs of shirts for 20,000 Rand from Bright wholesalers. Once the transaction has taken place, a source document is generated. So please find a list of all the different types of source documents and an explanation of everything. But there's information that we can draw from a source document. We can see the goods or services that was involved, the price of that, the date, and then the parties related to this transaction. So from the source document, we record each transaction in a big book called the journal. The journal is the first book we use. Journal entries work on a double entry system, where two things need to take place. Something is received and something is given up. In this case, you receive 200 shirts and you give up 20,000 Rand. Each journal entry consists of a date, a count, a debit, and a credit. So, the 1st of May, you bought 20,000 Rands worth of inventory, the t-shirts, and you paid 20,000 from your bank account, so your bank is credited. Once the transaction has been journalized, it's recorded in the ledger. The ledger is a recording that keeps all the debits and all the credits on different sides, so that the balance of each account can be calculated. Just remember that the journal is merely the record of transactions, and that the entry into the journal must now be grouped into similar accounts of which the balance must be obtained. A ledger shows us a number of things: the name of the account, the corresponding entries to the account. So we debit inventory by 20,000 and we credit cash or your bank by 20,000, and then we get the total of each entries. So we can assume that you have been the owner of Bright Gym for quite a while, and your bank had 190,000 from the previous month. You bought the 20,000 Rands worth of shirts, and now you have 170 left. But there's a correct way to close all accounts, and I'll show that to you at a later stage. As you can imagine, a big company like Bright Gym has hundreds of ledger entries. To solve this problem, the bookkeeper, that's now you, will draw up a trial balance. A trial balance will test the correctness of the double entry system. In order to draw up a trial balance, determine the balance and then post all the debits on one side and all the credits on the other side. And this too should always balance. This is because that for every debit entry, there must be a corresponding credit entry. And like I mentioned earlier on, that a business that grows will have numerous entries captured into the journal and then posted to the ledger. And this is where problems may creep in, because the debits and the credits might not add up. And questions that you can ask yourself as to why this is happening is: has each transaction been correctly recorded as either a debit or a credit and on the correct side? Have you lost track of what the balances of each account in the ledgers are and why the balances have been incorrectly calculated? So go back to the ledger, just make sure everything is calculated correctly, and then have you checked why the two columns add up incorrectly? Maybe you just forgot to make an entry, maybe you just switched two amounts around. But then there's always mistakes that a trial balance will not be able to identify, and that can be a transaction that has not been recorded at all, a transaction that's been recorded to the right side but the wrong account. For example, you post to vehicle account instead of the vehicle repairs account. A wrong amount recorded to both accounts, and then two mistakes that cancel each other out. So, at the end of an accounting period, the financial results of a business, along with the financial position of a business, are reported. These reports are summaries of the account transactions for the period concerned. The report is usually done in the form of financial statements. So we have the total profit or loss made in the period, as well as the assets and liability positions of an entity, and then the cash flow. First, we have an income statement. The statement merely reflects the results of the trading operation, meaning income minus expenses will give you your profit. The income statement is a financial history book, and this is because that anything that appears on here has already happened. Then we have a balance sheet, and a balance sheet is a list of your assets, your liabilities, and your equities. And just remember that liabilities plus equities is always equal to assets. Your balance sheet is often referred to as a financial snapshot. This is a picture of the business frozen in a moment of time, because what appears on the balance sheet is a reflection of the business at that instant. It does not and cannot show what happened to the business a moment before or what will happen to a moment after the balance sheet has been drawn up. Then we also have a cash flow statement. And a cash flow statement tracks the inflow and the outflow of cash in your business. And you can either use the direct or the indirect method, but I'll explain the difference between those two also in a bit more detail. Then we have the analysis and interpretation. The users of the financial statement will interpret and analyze the information that they contain. The profit and loss is considered in relation to the activity of the business, the money invested, and alternative investment options. This is called a general ratio analysis, but we'll look at gross profit, equity ratio, and current ratio, and much more in greater detail later on. So there you have it, the accounting cycle. You start with a transaction, then you record this transaction in your book of first entry. You summarize this transaction in your general ledger. You make sure it's correct by the trial balance. You report of financial information in your financial statements, and then investors and business owners use this to analyze and interpret the information that was given to them, and then of course they can make a decision.